Okay, with that, let's get started. Welcome to the February 9th edition of the Fats, Fuels, and Oils webinar. This week, we are going to cover the low CI feedstocks and DCO in particular. We really have had, DCO prices and the low CI feedstock prices have risen pretty sharply over the past couple of weeks. But it's the market is quiet, I guess, if a market can be quiet while going up pretty quickly. You still have the situation where there's a lot of near-term demand, and so that is helping lift prices. Although today I suspect prices will be off a little bit with soybean oil down quite a bit. But that demand is really kind of lifting the market, and it is keeping prices well supported, in addition to the rally that we saw in soybean oil. Now that rally slowed down a little bit last week, and it seems like the low CI feedstock markets were kind of quiet this week. So maybe things are gonna slow down a little bit. Our price forecast suggests that all of these prices are going to continue to rise, at least through the summer, and then into the fall, when we have the potential for a large U.S. harvest to kind of put pressure on prices post-harvest. So in the last at the end of the third quarter and the beginning of the fourth quarter. Now, as we've talked a lot about on this call, balancing that or potentially offsetting that is the increase in renewable diesel capacity. And that has become something that there's been a lot more uncertainty around it, just because of the high feedstock prices, and because some of the startup dates, I think, have slipped a little bit. We still expect that the bulk of the increase that we expected for 2022 will still happen, and it's just a question of when that's going to happen. Again, we had a lot of expansion expected to occur in the second quarter of this year, and we've shifted some of that out into the third and fourth quarters. Still, I don't think there's a question about whether this expansion is going to come. I think it's just more a question around the timing of it. So potentially we could have this situation where you get a big US harvest, and then and that weighs on prices, but at the same time you're expanding renewable diesel capacity, which should at least offset part of any pressure from the increase in supplies and lower potentially soybean prices. In the soybean oil section this week, I wrote a lot more about soybeans than I did soybean oil, because I think going forward, that's really going to be the driver for the soybean oil prices, and then hence the low CI feedstock prices. That said, if we talk specifically about DCO, what we have seen is an increase in production. Weekly data for January suggested that DCO production, based on where ethanol production is, should have been higher than it was last year. I don't think that's a huge surprise to anybody. And it also should have been down a little bit from December. I also don't think that's a big surprise for anybody. That's typically what happens. But I think the size of the decline in January was a bit smaller than we would usually see. And if the rest of the year follows sort of the typical seasonal trend, that suggests that DCO production, ethanol production, could be higher than we're expecting. Now, ultimately, ethanol production is obviously gated by gasoline demand, and so it's hard to imagine that we're going to get ethanol production that is up really significantly relative to gasoline demand. If you look at the ethanol blending in any given year, it sort of ranges between sort of 10.1 and 10.4% of of gasoline demand. And so we still expect that that holds true. Maybe it bumps up against the upper end of that range, and that's kind of what we're predicting. But either way, it looks like we're going to have more DCO supplies than we had last year. And of course, we're going to have more DCO demand than we had last year. And I think we're already seeing some of the producers, the renewable diesel producers that have expanded or have opened up, seem to be favoring DCO as a feedstock, at least right now. And again, that has kept sort of the spot market relatively tight. That and ongoing logistical issues have kept the spot market relatively tight, while demand in the out months is there, but it's not as strong as it might be if we expected a lot of these plants to open up in the second quarter. This week, I also wrote about DCO, about the strength of non-biofuel demand. We're expecting non-biofuel demand to rise relative to last year for DCO. Now, non-biofuel demand is sort of the residual part of the balance sheet. And so we kind of, it's just whatever is left over. We have a forecast for it, but that forecast can change more than our other forecasts, because as the other pieces of the puzzle sort of move around, then that implies something for non-biofuel demand. And so that forecast and those numbers tend to be much more volatile than the other parts of the balance sheet. But right now, it does look like we're going to see a small increase in DCO demand, non-biofuel demand, relative to last year. Whether that continues to hold throughout the year, and whether in August I'm still saying the same thing, remains to be seen. And I think that there's probably more downside risk to that forecast than there is upside. That said, North America and the US in particular are going to be short vegetable oils because of the drought in the northern plains and in Canada last year, that are reducing canola oil supplies. And we're really starting to see the impact of that on canola oil crushing. And so there is going to be strong non-biofuel demand for across all of the feedstocks. And for most of the non-biofuel applications, the cost of DCO or choice white grease or soybean oil, any of them, is a relatively small part of the overall cost structure. So the elasticity of the demand for non-biofuel tends to be smaller than it does for renewable diesel producers, even with the mandates. Obviously, the elasticity of demand for renewable fuel producers is pretty strong up to the mandate. After that, it obviously drops off pretty dramatically to whatever the profit margin is. And so this question about what the non-biofuel demand is going to be is kind of interesting. In the end, it's not a huge portion of, it's a third of sort of overall demand. And we're predicting it'll be about 900 million pounds this year. And so it's significant, but it's not as big as biofuel demand is expected to be this year. If non-biofuel demand, because it tends to be the marginal demand, if that is weaker than we expected, then our price outlook would probably drop off a little bit, but not that much. The other thing that I wanted to talk about when I was trying to think about stuff to talk about in DCO today is sort of a longer term think piece a little bit. And that is the potential for ethanol producers to raise DCO yields. We use a relatively constant yield for DCO because we don't really get enough data to calculate a yield that we really believe in on a month-to-month basis. But I've had conversations with people that believe that there are some ethanol plants that are already making improvements to their DCO yields, and they think that DCO yields could go substantially higher in the next couple of years with relatively minor investments. I don't know whether that's true or not, and it's tough to tell whether it's happening from the data again, because we basically estimate all of our DCO data based on other data. The data that USDA provides for corn oil is very tough to reconcile with other data that USDA provides for corn oil. So we tend to discount USDA's data. Of course, we look at it and we kind of make sure that the trends that we see in our numbers match with the trends that that USDA is seeing. But in terms of taking their data like we do for a lot of things, we don't necessarily take USDA's corn data. So that makes it very hard to kind of guess it or understand what kind of trends are going on in production and in yields. What I can say is that some of the people that I've spoken with believe that DCO yields could almost double or get very close to the amount of corn oil that's actually in a kernel of corn. And if that were to happen, that would obviously change the picture for DCO and the low CI feedstocks pretty substantially. Again, based on what we're seeing in prices and what we're hearing from the marketplace, it doesn't seem like this is happening on a big scale yet. And so we haven't ever really incorporated the potential increase in production that these yield improvements would imply. But it's something that we're keeping in the back of our mind. And if we do start to see it would really have to come through price movements. If we start to see DCO move in a way that doesn't really match up with the other low CI feedstocks, then we might start to change our yield assumptions. Again, it's not something that I think impacts the forecast in the next 1 to 3 months or 1 to 6 months, or maybe even over the next year. But it is something that could potentially impact DCO values in the long term. And as we go forward, if I hear anything that makes me think strongly one way or the other on this topic, I'll certainly will be happy to share that with you and let you know what we're thinking. But right now, I just wanted to bring it up in part because I need stuff to talk about during the low CI week, but also because it is something that I think is out there and potentially could impact the markets in the longer term. All right. The last thing that I'll say about DCO is you can see from our forecast, we kind of expect prices to stay in this 70 to 75 cent range. I feel like I say this every week, but I think there's probably significant upside price risk to the forecast. If energy prices continue to move higher, obviously that shifts the envelope of profitability for all the feedstocks higher, and they can go higher based on that. But also just the shortfall in vegetable oil supplies in the US and more broadly in the world are going to continue to support feedstock values, at least again until we get to the U.S. harvest. South American weather has not been what we've thought it was going to be, and so South American soybean production is down pretty sharply year over year, and that has some real implications for what we're going to need in terms of acreage from U.S. farmers this year. And there's some questions about whether we can actually get that acreage out of U.S. farmers. And again, you can read the soybean oil section and kind of get the details there. But assuming that we do get all of that, then I think prices can kind of stay in this range. If energy prices if oil goes up to $125 and every renewable diesel plant opens up in the second quarter of 2022, I think this forecast could look a lot different, and potentially I think you could almost maybe get to sort of $1 a pound kind of levels, maybe not for DCO, but for some of the other feedstocks that don't also benefit from whose supplies don't also benefit from higher energy prices. All right, with that, let's go to biomass-based diesel and gross margins. So our forecast for gross margins rose modestly last week. For biomass-based diesel, prices actually, I've got to look into these graphs. This doesn't show it. It's like it's a week behind. Okay, so prices rose from a 9-cent loss to a 2-cent profit. And for renewable diesel, they rose from $1.83 per gallon to $1.84 per gallon. Our estimates with the value of credits included. The bulk of the increase was really driven by sharply higher energy prices. So biodiesel prices in California rose from $6.05 a gallon in the second week of January to like $6.50 a gallon in this last week, and that more than offset the increases that we saw in feedstock prices. Although I think the increases and again, if you sort of think of because of the assumptions that we've made about feedstock mixes, it tends to mean that biodiesel is producing biofuel out of soybean oil, and renewable diesel is producing biofuel out of fats and greases. The increases in fats and grease prices over the last month or so have been much larger than the increases in soybean oil. Soybean oil had a big run here the last couple of weeks, but I think in general, you saw some of the low CI feedstocks up more than 10 cents a pound over the past month or so. And so that really kind of limited the rise in profitability for our theoretical renewable diesel plant in California. Going forward, we expect rising feedstock prices to continue to weigh on profitability, but we also have built into our forecasts sort of a lower energy prices, and I don't know that is going to be realized. I mean, there are obviously some things that could happen that could make that a reality, but it seems like the list of things that are going to make energy prices go up is much longer than the list of things that are going to make energy prices go down. So I would say that there's a chance that we're being a little bit pessimistic in terms of our forecast going forward. Now, our forecast going forward shows biodiesel margins falling to like a loss of 50 cents per gallon, which I think is obviously pretty extreme. But what I also think is that if you assume that our feedstock forecasts are right, but our energy price forecasts are a little bit low, then maybe you trim that loss a little bit, but it certainly doesn't suggest that all of a sudden biodiesel is going to be worth, biodiesel production is going to generate 50 cent a gallon profits. And so while our profitability forecast for both biodiesel and renewable diesel may be a little bit low, I think that the trends that they suggest are probably in the right direction. And if you think about it, if energy prices go up, that probably means that feedstock prices are going to go up as well. And what that really suggests is that it's going to be tough to get profitability back up to the levels that we saw last year for the low CI feedstocks. But it's probably also not likely that we're going to see profitability levels for biodiesel at the levels that we saw for biodiesel last year either. It's probably somewhere in the middle. A big input to that is obviously our RIN price forecast, which only changed modestly this week. We still expect RIN prices to move up from here forward. That's really driven a lot by our expectations for feedstock prices. We're sort of slowly feathering in the idea that the ethanol blend wall may narrow the spread between D6 and D4 RIN prices, I think there's a solid argument that you can make that would suggest that that's actually going to happen. But until I get more comfortable with that idea, really, to be frank about it, it's not something that I want to predict. I don't want to predict that the spread goes to $5 or something this early in the year, and then just have that be totally wrong. I would rather kind of, as we move in that direction, start to increase the probability that we hit the ethanol blend wall than to make sort of an extreme prediction now and then need to roll it back in the future. So again, I think that there's potentially more upside price risk for RIN prices, although our forecast already suggests that RIN prices will reach record levels. But if we get the ethanol blend wall problem or issue, and we also get higher feedstock prices, then I think there's every reason to believe that RIN prices could breach the levels that we saw last summer. And our LCFS credit price is unchanged. The market is really stabilized around 150, and maybe that ultimately is the bottom in it. We still believe that rising renewable fuel supplies will ultimately pressure the market. I'm going through our 10-year forecast in order to publish our quarterly outlook on February 15th. And if you look at the increase in production and renewable diesel and look at the sort of the historical percent that goes into California, it's really hard to craft a scenario where we get less renewable diesel into California, and as a result, that should weigh on LCFS credit prices. Again, there is some chance, I don't have a great handle on what the probability is. There is some chance that CARB comes in and does something, but thus far, I don't think that they have wanted to do anything, or they haven't done anything that I know of yet. And so I think maybe as long as prices can stabilize around this 150 area, that they probably will stay on the sidelines. If we start to go down and get down towards 115 or 100, then maybe that's a little bit different question. All right, I will take your questions now. So what are the current DCO yields in percentage? I don't know the percentage off the top of my head. Let me see if I could figure that out. 0.8. I think it's about 1.5%. If I use 0.8 pounds on a 56-pound bushel, if I use 0.8 on a 60-pound bushel, it's 1.3. So somewhere in there, I can never remember whether corn is 56 or 60. And that's assuming a 0.8 pound per bushel yield for DCO, which is what we use. So it's not that much, but again, if you could double it, that would make a big difference in the supply of DCO and the supply of low CI feedstocks and vegetable oils more broadly. And the investment, at least as far as I can gather, the investment to double the DCO yield is in the order of a couple of millions of dollars, which obviously is a lot of money. But if you think about the return on that investment, it doesn't seem like it's that high a bar. The thing that makes me sort of hesitant to really adopt this idea is the fact that if it is so easy to do and it costs so little and the returns are so great, then I would think that we would already be seeing this in the numbers and in the market. And Ryan and I have talked a bit about this, and we really haven't seen anything yet that gives us a lot of confidence that it's happening. Doesn't mean that it's not happening or that it's not going to happen. It just means that there's nothing that we can really sort of sink our teeth into and say, okay, this is happening, and we're going to start to use this in our forecasts. Can you share a little more about the shortfall in canola supply coming out of Canada that you referenced earlier in the call related to the overall vegetable oil shortage? So the Canadian crop and the US crop both were significantly lower than we expected, or than people expected earlier in the year, and then they were the prior year. And this is really kind of the second year for a shortfall in the Canadian crop. Last year we had record canola crush out of Canada, but as a result of that, Canada drew its canola seed stocks down pretty sharply, and so they don't really have much of a buffer to deal with this year's shortfall. And so we have been expecting this slowdown in crush, just sort of a big slowdown in crush, to start to impact vegetable oil supplies. So far, the slowdown hasn't been as dramatic as we had expected. And just for reference, so for Canada, last year's crush was about 1.3 million tons, I think. And just for Chris, yeah, if you send me an email, I'll send you a link to the recording. So last year, Canada crushed about 10.35 million tons of canola seed. This year, we just lowered our forecast to 8.15, I think, million tons. And I think that that number implies a pretty hefty crush going forward relative to what we saw, or what we think we saw in December based on the weekly data, and or January based on the weekly data, and what we've seen in the first 2 days that we have data for in February. The February number is probably going to come up, but those numbers are like 640,000 tons a month. And last year at the same time, we were crushing about 915,000 tons a month. So pretty big drop off, and that could be smaller. Our 8.15 number could be smaller in the coming months. The big question there then is, how much canola oil does Canada use domestically versus how much do they export? And they export the vast majority of their production. Their production this year is going to be like 3.7, 3.8 million tons, and they're going to export 2.8 or 2.7 million tons of that. So they export the vast majority of their canola oil. The question is, how elastic is that domestic demand? Is it going to stick pretty hard at about 1 million tons, which is where it's been the last couple of years, or will high prices, especially in the US, draw in more exports? It's really tough to say right now where that coin is going to fall. Exports have been, I think, surprisingly strong, or US imports have been surprisingly strong at this point. But between now and when canola harvest starts later this summer is when we're really going to start to get down to the end of the canola stocks that are around and available to be crushed. And so exports have been strong, but maybe they're going to start to drop off in the same way that we've seen the drop off in crushing. The other variable in this whole equation is that China has typically taken a lot of canola seed out of Canada to crush domestically, and China is systemically short vegetable oil. If you look at the growth in China's domestic vegetable oil usage year over year and the increase in their domestic production, they are always short, and so they always have to import some oil. And so if they can't import canola seed from Canada, they're going to have to find the oil someplace else. Now, early in the season, we saw some big imports or some big exports from Canada out, a lot of it to China. Those have slowed a bit, but that competition I think is going to remain. And if you think about it, the shortfall in South American production is going to potentially going to leave China short soybeans as well. And so the demand for that seed for China is going to be just that much stronger. And every ton of canola seed that gets exported is obviously a ton that can't be crushed. And so that's the dynamic at play in trying to forecast Canada's crush number. We think that the market will prefer that Canada crushes canola domestically and then exports the oil, and that's the way that we've set our forecast up. I think if there were sort of a different setup, I probably would have split the decrease in canola seed supply more evenly between a reduction in exports and a reduction in crush. But because North America generally is short vegetable oils, I've leaned more on the reduction in exports than I have crush. That has left me with a crush forecast that's maybe too high, and again is maybe going to come down in the coming months. We're just going to have to kind of lean on the weekly data that we get and see where we're at the end of each month. In your RIN forecast, are you factoring in the increases in supply from HRD capacity build out? If so, what level of increase are you assuming key to length and overall credits due to nesting? We do, and there's some balance there that I think it makes sense to think about. But if you look at RIN prices historically and you try to model the changes in RIN prices historically, it really comes down to two things. It really comes down to feedstock costs and to the level of D6 prices, which also sort of allows this ethanol blend wall to be included in your forecast. And so if you think about it from just that perspective, then right now, if we assume that the ethanol blend wall is not going to be a problem, then you're just down to basically your feedstock forecast is the driver for your RIN price forecast. If you think that the ethanol blend wall is going to be a problem, then you need to include that in. The increase, the build out in HRD capacity means that obviously there's going to be more supply, and typically you would think of, okay, more supply means lower prices. That is true, but it's only true if in this case, it's only true if the supply starts to really exceed the demand set forth either by the mandate or just the demand, like in ethanol's case, just the demand from gasoline consumption. And so there's this, because the demand from gasoline consumption is short of what the ethanol mandate is, there's this gap between the amount of ethanol that we're going to produce, or that we think we're going to produce, and what the mandate requires, which obviously can be met by D4 RINs and would suggest even more production. But that additional production kind of doesn't count towards weighing on RIN prices, because those RINs are going to automatically be needed to meet the mandate. Or you're going to have a situation really where, and this is why the spreads tend to narrow, you have people that will produce excess D4 RINs and they'll sell those RINs, and then they'll go buy D6 RINs if they have D6 RVOs. So we do think about that. It's tough to say that for this amount of increase in capacity, there will be this impact on RIN prices. But I think that that does get reflected in sort of the opposite way in the feedstock markets, and then it comes in again in the opposite way through that. So the increase in capacity is going to raise feedstock prices, and then feedstock prices are going to require higher feedstock prices are going to require higher RIN prices for all of these people to operate profitably. If they don't, if RIN prices don't rise, then you get a situation where production isn't as strong as it otherwise would be, and that also supports RIN prices. So it's very hard to get to craft a scenario where you have an increase in capacity that floods the RIN market with supplies and weighs on RIN prices. Now, in the California LCFS market, it's kind of the opposite, because that's a subset of the overall US market. You can, and what we're seeing is a flood of renewable fuel into the California market that is then weighing on LCFS credit prices. And theoretically, lower LCFS credit prices also should support higher RIN prices. And now that's not included in our model, but if you just think about it from an overall profitability standpoint, if LCFS prices go down, there's some level of the loss in profitability from $200 a metric ton to $150 a metric ton that will either need to be made up through higher RIN prices or lower feedstock prices. Given that lower feedstock prices seem really difficult, since the world fundamentals are bullish, US fundamentals are bullish, then I think that also kind of suggests higher RIN prices, which is why all of that kind of in our minds adds up to a potential for record RIN prices this year. Now, we run our forecast models every week. That can change, but it's the setup this year looks like we're almost locked into the setup this year makes it very difficult to see a scenario where RIN prices would move substantially lower from their current levels. It's very easy to see a lot of scenarios where RIN prices would move significantly higher from their current levels. Now, the one scenario that I could see is if you just get a big collapse in energy prices, and then you have to have lower feedstock prices and probably lower RIN prices as well. But again, it seems difficult to imagine a scenario where we get significantly lower RIN prices. All right. I hope that helps. And if anybody has any other questions, please feel free to reach out to me. Just send me an email and I will respond. Thanks for being here this week. Next week, I think, is President's Day. Next week or the next week, one of the next 2 weeks will be President's Day. Whenever we have President's Day, we won't have this call on Tuesday because we'll publish the report on Tuesday and we're off Monday. The markets are closed Monday. So on President's Day week, whenever that comes, don't show up for this call because we won't be here. All right, everybody have a great week, and I will see you next week or the next week.